Hello, welcome back to Weekly Market Recap here with Knight. Let's get to it. So the past week, the S&P fell 1.57%, brings us down year to date 24.82%. The NASDAQ 100 fell 3.21%, which brings us down year to date 34.09%. So we took out the lows for the year in both the NASDAQ and the S&P. So we're making new lows for the year, and let's talk about why. So we'll jump into the market, and we see that the beginning of the week, relatively calm, some movements up and down, all waiting on Thursday, which was going to be the big CPI release, see if inflation is slowing down. And if you see exactly what happened, CPI data came out and we immediately fell to a yearly low in the S&P 500. But shockingly, by the end of the day, we had actually recovered significantly. Seems like we were going to potentially end the week higher, and then the consumer confidence reports from Michigan came out and we ended up going back down. But let's first, before we get into the consumer data on Friday, let's talk about CPI. So let's talk about inflation. Now, before we get to the numbers, it's important to know what the market was expecting. So headline number that the market wanted to see was 0.2% month over month and 8.1% year over year. And then they were hoping that core would be in at 0.4% month over month. Let's look at what the numbers actually said. So month over month headline, we had 0.4. We were expecting 0.2. That was a miss. Headline year over year, 8.2. We were expecting 8.1. That was a miss. Then if we look at core, all items less food and energy, 0.6. We were hoping for 0.4. That was a miss. So miss, miss, miss. Thus, we got a big sell-off in the market. One of the things that's scary about inflation that we've talked about for a while is, when is it broadening out and becoming more entrenched? And so if we look at all the specific data, when we really think of entrenchment, we think of the services. So let's go down to some of the service areas. Goods, again, we've seen over here a lot of volatility, but when we start to get to services, less energy services, oh no, that's not good. We went from 0.4, 0.6, 0.8. That's all services, less the energy services. Shelter, again, 0.5, 0.7, 0.7. So that's staying high. That came in higher. Rent of shelter, primary residence, again, that ticked up. We did see lodging away from home come down pretty significantly. But again, overall owner's equivalent rent, that rose. These numbers that have a massive weight in the CPI reading are all going up. They're not trending down. And the market saw that, freaked out to the negative end, and then recovered for the rest of the day. But then we had some more bad news on Friday. And one of the biggest differences that we've talked about for a while, why our current experience, even though we're having really high inflation, is different than what happened in the 70s with Volcker, where he had to raise interest rates to 20%. Look, we're nowhere close to that. We're currently at 3.25% in the Fed funds rate, and we're expecting probably another 75 basis points, which would bring us to 4%, and then one more 50 basis point hike, which would bring us to 4.5%. That is so far off from that 20% that Volcker needed to do. And again, the biggest reason why we've been able to do that is because we have had anchored inflation expectations. And we've looked at this a lot. We can tell what the market is expecting by comparing the 5-year break-even rates between the TIPS, which is the Treasury inflation protected securities, versus just the 5-year Treasury. And then on the consumer side, it's measured by the University of Michigan consumer sentiment data. Now, that came out on Friday, and we've been actually trending down in our 1-year expectation of inflation. It was at around 5% earlier, then it went to 4.9, 4.8, 4.7 was our last reading, and economists were expecting 4.6. So trending down, great. Anchored inflation expectations still lower. Well, the data came out and we actually got 5.1% as the expectation for the 1-year inflation rate. Now that's a big deal, because if we continue to see inflation expectations go higher, the Fed is going to have to be more aggressive and restrictive. So the market, again, started to recover from Thursday's reading, thinking, okay, maybe it's not as bad. We already expected the Fed to raise 75 basis points. We're expecting maybe by the end of the year, 4.5% in the Fed funds rate. We're already expecting this. Didn't really change the path. As long as we have anchored inflation expectations, we can get back. And then Friday came, oh no, we might not have that same anchored inflation expectations. And that questioning, even that coming into question, really led to the sell-off. And again, we can just look at what happened in the market. The day started, and right before the inflation expectations came out for the consumer side, we actually were starting to rise. And then that data came out and it was just bleed out for the rest of the day, sharp decline and then bleed out. Now, we didn't reach the year-to-date lows that we reached on Thursday morning, but we still ended the day lower when we looked like we were actually potentially on the path for an up week. So right now, we got through a couple of the really big catalysts, not great data, but now it's on to earnings season. We just had banks come out. JP Morgan actually beat expectations. So if we have a really strong earnings season, it will be mixed, because the good news is if we have stronger earnings, we might not see the same multiple compression. We might not see the stock market sell off from worry about, oh my God, companies aren't earning anything. But the bad news of having stronger earnings is it gives the Fed more ammo to say, wait a minute, people are still spending too much. Demand is not anchored. We need to destroy demand. We need to get more unemployment. We need to get that unemployment rate rising. And so we're still in this bad place of, if we get bad earnings, then we're worried stocks are probably going to sell off because we're worried about a recession. If we get really strong earnings, then stocks might sell off because we're worried about how the Fed's going to react to strong earnings. Right now, it's still a difficult position to be in, but we have to take the longer view. So in the short run, it's really difficult to say that equities are a place to be. A lot of people who are dollar cost averaging continue investing in the market. It feels like you're just investing in every day. It's selling off. You're just throwing your money into the fire and it's just burning, burning, burning. But we have to take that longer term view. And right now, stocks have declined significantly. They're off close to 25%, just the S&P. And then NASDAQ, more tech heavy stocks, are off close to 34-35% for the year. That's a heavy discount compared to buying back in January, back in December, back in November of the last year. So being able to get in at some of these lower equity valuations could, in the long run, have a better approach for the portfolio. So even though in this short run, it's probably still going to be a tough end of the year. It might even be a tough 2023, looking at how that's going to shape up with the Fed. When are they going to just pause rates? What is their terminal rate going to be? It's difficult to say, but what we do know is over the long run, investing in these times is some of the best times for market returns, investing during recessions. So if you have the ability to stay patient, stay in the market, try to add to your portfolios where you can. We've definitely seen in the past that being a really strong lead and support for an individual's portfolio and individual's whole financial plan. So as difficult as it is to just look right now at the portfolio, see how the market is doing, looking in the broader view, this is actually maybe not the worst time to be investing more in a diversified way into your portfolio for the long run. So really appreciate you guys spending the time with me today. As always, we're here to support you. Your Mind's here to support you. See you again next week.